PepsiCo stock has plunged by more than a third from its highs, and yet the underlying business remains rock solid. I saw the drop of 33%. I got very interested in the stock, went deep on analyzing and decided to load up on it. There's no scandal, no earnings collapse, just a rare chance to buy a global powerhouse that's on sale. So this is my eToro portfolio. You can see all my trades here. You can see here I have allocated around 11% to PepsiCo stock, and you can find a link in the description with my eToro profile. So let's get into it. PepsiCo stock market is just opened and it's up 0.5%, but doesn't really matter. It's not a lot. But yeah, PepsiCo stock has a market cap of 180 billion right now, revenue of 91 billion, P ratio of 19, forward P 16, and a dividend, quite a fat dividend, paying 4.3%. And let's just take a look at the graph real quick. If you can see, it's just a hill. Yeah, like a fat hill, going up nicely and then going down. I like to buy stuff when it's down. I don't buy here. I don't buy here. I'm not even buying here. It's not enough. At 160, I did start to monitor the stock when it got around 140, 143, around this area. And then when it jumped back up to 150, I said, yeah, I missed the boat. I'm not interested anymore. But it got down to 130, and then, yeah, it striked. I personally believe it's a great price to buy it at. And we're going to take a look at the numbers a little bit. So let's take a look at the top line revenue. 2015, 63 billion. It did have a big increase in revenue over a period of 5 years or so. From 2020 to 2021, they added a lot. As you can see here, 13%. Yeah, 13.96. So what can we say by looking at it? So first of all, whenever you're buying a stock that's declining, you have to know what's going on. So first thing you have to look at is top line growth or decline. I don't see any decline here. I just see high growth for a very mature company for a couple of years and then starting to cool off. It's just cooling off. It's not even declining. Last year, 2024, it cooled off, and this year it's looking to cool off some more. It's not a problem at all. Actually, it looks pretty great. But yeah, we don't want to see red flags. We don't want to see declining revenue. We don't want to see anything like that. What else? We want to take a look at shares outstanding usually, but for a mature company, for sure, they're not gonna dilute us. I mean, it would be pretty crazy if they started to. It would mean they have real trouble. So we don't see any type of dilution. Let's take a look at the quarterly. See how smooth is going down. Yeah, shares outstanding. Going down nicely, but kind of flatlining last few years, as you can see here. 0.3% reduction, 0.36. These are small amounts of shares bought back, but it's very good to see that it's in the green. It's shares reduction, not adding anything to it. It gives us more confidence to buy the stock. There is a floor when it comes to the share buybacks as well. This company is doing buybacks. The management is looking to do buybacks. So we kind of have a floor there helping us as well, not just the dividend. Next, we have to take a look at the margins. Again, looking for any type of deterioration and declining margins. But we can see 10 years ago it was basically the same. 55% this year, 10 years ago 54. Same with operating, same with profits. Actually, profit is looks a little bit better. And free cash flow margins, kind of the same. Doesn't really matter. Next, you want to take a look at the balance sheet. Cash and cash equivalents. Not at the lowest point, not at the highest. A little bit above average. So they do have quite a bit of cash in the bank. This is also good for us, just in case there's a steep drop in price. They do have the cash to just buy back shares. When we want to take a look at total assets, we want to see this going up over time. Now, total liabilities will also go up over time as the company grows, but you want to see the result of the shareholders' equity going up more. So yeah, when this also is going up, it means that the assets are going up faster than the liability. So this is what we want to see. Net cash debt minus 39 billion, minus 40 billion, let's say. They took a bunch of debt in 2020 when it was cheap. Not so much after that, but you want to take a look at what's going on with the debt. How can they service that debt? Doesn't matter the amount, it's the servicing that you need to worry about. So here at the statistics page, you can see financial position. You can see the current ratio, debt to equity 2.6%, debt to EBITDA 2.6%, and the interest coverage, which is what you want to find out, is 16%. So nothing reckless here, nothing that's unmanageable. It's not fortress level. This is not a software with no debt type of company. They do have capex, they do have to spend, they do have to take on debt, but there's not any issues with this type of debt levels. Net income, let's see here, trending up over time. Of course, this is what we want to see. 2015, 5.4 billion. 10 years later, they added about $4 billion in net income. So let's keep that in mind. We're sitting at around $9.4 billion of net income. Stock-based compensation, we do not want to see high growth in stock-based compensation, and we don't want to see a big ratio when it comes to stock-based compensation compared to net income or revenue or anything like that. This is a consumer staples company. There's no need for high growth in stock-based compensation, okay? There's no reason for it at all. So we don't see that. I'm very pleased with what I see. 10 years ago, it was 300 million of stock-based comp, and now it's 342 million. That's okay. What else do we need to take a look at here at the cash flow statement? We want to take a look at the common dividends paid. We want to take a look at and visualize the graph here. So we do want growth in our dividends, but we don't want exponential growth. We just want the management to do responsible things and not to blow up the company, okay? What do I mean by that? I do want to see a very mature company like this grow the dividends, of course. I do want growth. I generally invest only in companies that grow at a reasonable pace. Like a very mature company like this, I would be okay with a dividend growth of 5% year on year on average. So I do see here 10 years ago they were paying out $4.2 billion. This year is 7.3. That's a high increase, but it's not exponential. So you don't see like a curve, like a curve type of graph, you know. Also, you want to take a look at share buybacks, repurchase of common stock. So here we do see that they have bought back every single year for the past 10 years, except 2021. I don't know why. Maybe they didn't have the cash. Maybe they did some other stuff. From what I know, they are involved in Celsius stock. They own a little bit of the company or something like that. But yeah, they did around $5 billion in cash buybacks 10 years ago. So if growth somehow accelerates again, they can accelerate the buybacks as well. But this makes me happy to see that we do have a very solid floor of dividends and buybacks, keeping the price. It's going to offer a very solid floor. And the payout ratio for the dividend is 80%, which is high. Yes, it's high, but it's manageable. Okay, they can pay it out. It's at all-time high, but a little bit of growth and they're okay again. And anyway, the management of Pepsi stock, they have been doing very well over the past 50 years. From what I understand, it's a dividend king. It has been increasing the dividend for more than 50 years, 53 I believe. So the management knows what they are doing. They're not irresponsible. They're not growing it too much, just the right amount, and they know what company they run. So let's take a look at the valuation, and then we're just gonna end the video. PE ratio, as you can see, since the price started to drop, it's also been on a decline. So this is great to see. Also been dropping by a third, and it's not at an all-time low, but it's at 19 for a company that is still growing. This is quite okay. Forward P, it's at the 10-year low. This is a good sign. Helps us make a better decision. Makes me want to allocate more when I see a 10-year low. Now, obviously, there's a lot of fear surrounding Pepsi stock. I don't even read the news. I don't really care why, because I don't see anything wrong with the company. They are still producing excellent results, and I see no signs of deterioration in the margins and in other metrics. There are two other metrics that I take a look at, but yeah, EV to EBITDA, this is another valuation metric that I look at. Another low for the last 10 years. This is good for us. We're buying it at a very good price. So this is another metric that I use. Return on capital invested. It's been flatlining. We don't want to see this declining. We don't want to see any red flags, any sign that the company is deteriorating. Maybe a new player coming in. Maybe they have a weak moat, or I don't know, consumer preference change or something like that. I don't see anything like that in here, in all of these stats. Return on capital employed. This is a stat that matters to me a lot. I've learned how to use this from Terry Smith, but Warren Buffett and Charlie Munger also talked about this. Yeah, I like what I see here, kind of flatlining for a mature company. This is what you want to see. Obviously, if this goes up, if this starts to go up a bit, it would be perfect. I would even maybe go all in on the stock if I would see stuff like that. Fundamentals of the company improving while the stock price going down. So that would be the perfect scenario. And I do have stocks like that in my portfolio, but for a mature company like this, I mean, we cannot ask for everything. Just to buy it cheap and hold it for a couple of years, that's all we can do. We buy low and sell high. FCF yield, free cash flow yield, not at the highest over the last 10 years, but sitting at 4% right now. It's quite a bit more than the market. The S&P 500 is, I think, around 3% or lower, maybe 2.8, something like that. I will check after the video. But anyway, I think, in my opinion, PepsiCo is a little bit better than the averages in the S&P 500. So buying this at a great discount while getting paid more than 4% in dividends is a good scenario for us. I want to show you some other things. Market cap, price history. I want to show you during the financial crisis, the stock price dropped almost 40%, 37%. And now we have a stock price drop of 31%. And we are not in a financial crisis. So occasions like this to buy the stock so at a discount so big are not going to come so often. This is a very rare occasion, okay? I'm going to tell you right now. Also, I want to show you the dividend yield. During the financial crisis, the highest dividend yield that you could have gotten it was 3.4%. So now it's at more than it's 4.3%. You're getting it. Yeah, it had a very good level, to be honest. Other stuff you can look at is here on Ticker Terminal website. You can put on the graph, you can put the price on the graph, and then you can overlap it with the valuation, enterprise value to EBITDA, what we just looked at. And let's just look at the last 10 years. So as you can see, there's multiple expansion here, price going up, valuation also going up, until it started to drop, but the valuation dropped a lot more than the price. Well, not a lot more, but quite a bit more. So it's not like, the market is just has decided to allocate a lower multiple. So we had multiple expansion, and now we have multiple contraction. But it's not true, because the company also improved fundamentals over the last 5 years. If you take a look at the graph here at the black line, which is the valuation, it's zigzagging sideways for a few years, for 3 years, and then it goes down. And overall, over the last 10 years, you can clearly see that the valuation has dropped quite a bit more than the stock price. So what does this mean? This means the company is still growing. This means it has growth in it. So not only that you're getting it about a third cheaper in price, but in valuation you're getting it quite a bit more cheaper. Also, what I wanted to show you is Shiller PE ratio. As you know, after 1980, when the Fed started to lower rates, everything went up in price and valuation in the stock market, and the Fed has kept rates very low, so we will probably have higher valuation than before 1980. So we're just gonna take a look at the last 20 years. But as you can see, we're kind of at an all-time high, not all-time high, but at a high of 37 over the last 20 years. During the dot-com bubble, it hit 44. This is the S&P 500. Shiller PE ratio, also known as the CAPE ratio, average inflation adjusted earnings from the previous 10 years. So what does this mean? This means that when the valuations are high like this, I think it's a good idea to have a defensive stock in your portfolio like Pepsi. PepsiCo stock, the earnings, the revenue did not even flinch during the financial crisis. It remained flat for a year, 43 billion to 43 billion. So this company is rock solid. I mean, yeah, I don't know. I'm very happy to have bought it at this price at 129, 130, let's say. And I'm looking to hold it for about 2-3 years until the price recovers. Maybe not until it hits all-time highs again, but all I know that I've bought a very high quality company at a cheap price while I'm getting paid a dividend of more than 4% just to wait until the price recovers. So I'm looking to get maybe 50% on this investment combined with the dividends and dividends reinvested, maybe 70% before I exit. I could be taking a little bit of profit at 150 or so, but we'll see. Anyway, good luck in the stock market, guys.